Mutual funds are very popular and favorable for several investors. As the name suggests, mutual funds mean to collect funds from several investors and invest in a portfolio of assets to gain higher returns. In this video, we will tell what is a mutual fund, investing tips for beginners. 10. What are mutual funds? Mutual funds are a general term for funds that allow you to pool your money with that of other investors and are managed by a team of investment professionals. The term may vary across countries, but mutual funds may also be referred to as collective investment schemes, unit trusts, or simply as funds. The pooling of your money generally creates greater buying power, so you are able to invest in a wider range of investments than possible for most individual investors. Each investor in a fund owns units, or shares, which represent a part of a fund's portfolio holdings. Mutual funds can be categorized by the type of assets they invest in, such as shares, bonds, cash, or other securities. You can refer to the mutual fund's prospectus and fact sheet to get a better understanding of their respective investment objectives and policy. For example, type and mix of investments, and past performance. Mutual funds are open-ended funds, but some investment schemes are structured as close-ended, open-ended funds, can issue and redeem units at times specified to meet subscription or redemption requests made by investors. Generally, buying and selling of units takes place directly between investors and the fund or its agents. The price per unit of an open-end fund will vary in proportion to the fund's net asset value, and therefore reflect the fund's performance. The price per unit of an open-end fund is known as its net asset value, or NAV. 9. Types of mutual funds that are available. There are many types of mutual funds, but broadly speaking, they can be divided into four main categories. Equity stock funds. As the name suggests, equity funds consist mainly of stock investments and are the most common type of mutual funds. Equity funds focus on a particular type of investment strategy, such as growth, value, large caps, and small caps, or themes such as property, energy, and healthcare. The underlying shares can be invested globally, regionally, or in single countries. Bond, fixed income funds. Bond funds invest mainly in debt instruments including government bonds, corporate bonds, or mortgage-backed securities. The return that a bond fund may have can vary depending on the type of bond. Typically, bond funds that invest in short-term bonds tend to be less volatile than long-term bonds. Bond funds that invest in corporate bonds generally do so to obtain higher yields, thus carrying greater risk than government bonds. Money market funds. Money market funds seek to maintain a stable net asset value by investing in the short-term, high-grade securities sold in the money market. These are generally the safest, most stable securities available, including treasury bills, certificates of deposit, and commercial paper. Hybrid, multi-asset funds. Hybrid funds invest in a mix of stocks and bonds and may also hold money market instruments, which can vary proportionally over time or remain fixed. 8. Benefits of investing in mutual funds. A mutual fund can give you instant diversification. With as little as $1,000 US, you can buy a fund which invests in equity and bond markets around the world. The investment risk is spread over many securities, thus potentially reducing the volatility of your portfolio. You can enjoy professional management when you invest in a mutual fund. The investment professionals will manage the funds on your behalf using their experience, skills, and resources. Generally, for mutual funds that are priced daily and open-ended, you can redeem your units any day and get your money back promptly at the prevailing price, net asset value of the fund. It is best to refer to the fund's prospectus or fact sheets to better understand the price at which the fund will redeem your units. Conveniently and easily cash out your investment at any time at market value within 10 international business working days. Start investing from as low as USD 100 through the monthly plan or an initial lump sum of USD 1,000. 7. How do you choose mutual funds for your portfolio? Given that there are so many mutual funds to choose from, having a checklist of factors to consider can help you narrow down your fund selection. When it comes to choosing which mutual funds to invest in, start with your investment goal and time frame. These two elements will help determine what type of mutual fund you should use. For instance, if you're investing for retirement 30 years in the future, you can choose a more aggressive, stock-heavy mutual fund than someone investing to buy a yacht in 5 years. Generally speaking, the shorter your time horizon, the more conservative your mutual fund should be. Longer-term investors can afford to take on more risk as they'll have time to wait out any stock market declines. An investor with a 30-year retirement goal who isn't afraid of seeing their investments fluctuate in value between now and then could use a 90-10 or 80-20 asset allocation fund. These will invest 90% or 80% of their assets in stocks, respectively, and the rest in bonds. Less aggressive investors may opt for a 70-30 or 60-40 allocation. Experts say you want to adjust your asset allocation and grow more conservative with age. Next are some tips on investing in mutual funds that will help every investor to have higher return potential by selecting the best mutual funds all by themselves. 6. Prepare well. Before starting to invest in mutual funds, an investor should prepare well to turn their investment into a profitable and successful one. Whether a beginner or a seasoned investor, it is always good to take some essential advice from your financial advisor. An investor looking to learn and invest simultaneously should answer all the questions related to their financial goals, retirement plans, strong corpus, and mainly the period of investment. Different mutual funds have different types of risks and profit that can turn out to be rewarding or loss. Thus, an investor should prepare well to earn profit and to save themselves from significant losses. 5. Build a strong and well-diversified portfolio. Many mutual funds invest your hard-earned money directly in blue-chip companies, whereas others invest in particular segments like banking, real estate, and more. Some mutual funds can offer a mixture of equity funds and debt per your requirements to deliver more flexibility. Thus, an investor chooses the appropriate mix and profiles to get valuable and profitable returns. If an investor is looking to invest in 1 or 2 equity funds, they must diversify across several sectors and asset class to build a strong portfolio. 4. Read and understand the tax laws. In investment, several people say that a rupee saved is a rupee earned, which is true. But tax can eat up all your returns. Therefore, it is essential to know the tax slab when investors are looking to redeem their investments. In addition, several mutual fund schemes like Equity-Linked Savings Scheme offer a tax benefit to their users. 3. Build a strategy focused on long-term growth. Mutual funds are not known as quick-rich schemes. Instead, an investor has to think as a long-term investment horizon to reap the highest returns. Those investors looking to invest for 5 years or more must look for equity-oriented mutual funds, because equity markets rise upwards in the long term, while in the short term they remain volatile, which can be either profit or loss. The ideal strategy is to make equity investments along with short-term investment holdings to maintain the liquidity of their portfolio. Thus, investing in debt funds will help an investor meet emergency requirements in cash without sacrificing their long-term opportunities to get higher returns. 2. Know when to exit a mutual fund. It is important for an investor to know when to exit from a mutual fund. Unfortunately, when the market enters a bearish phase, several investors make the mistake of exiting from mutual funds, which is a wrong practice and not a recommended strategy. The fund managers who are capable enough know how to jump back from the bearish phase and use it to their full advantage. There are a few signs that investors should know when to exit from a mutual fund, such as when they have achieved their goal from a fund, when there is a change in investment objectives of the fund that does not match with its goals, when the fund performs badly for a longer period. Number 1. Keep investment objectives clear. An investor should keep their investment objectives clear before heading towards investing in mutual funds. Mutual funds are known as flexible financial products, which an investor can start today just by investing with RS 500. Apart from the ELSS schemes and closed-ended funds, an investor can invest in any mutual funds and redeem at any time, as per their choice. This allows investors to select their desired mutual funds by keeping in mind their investment objective. For example, if an investor is looking to save money on income tax and wants to stay invested for a long period, ELSS is the perfect and ideal investment for them. On the other hand, if they want to invest their money for the short term and want to maintain a good level of liquidity by receiving higher returns, a short-term debt fund or a liquid fund is the right option for their investment. Do let us know in the comments if you are interested in buying mutual funds. Thanks for watching.